Coming up today, stocks continue to rally on the back of a huge Nvidia deal. Apple continues to surge. Is the tech bubble just getting started? Crypto pulls back. Should you buy gold here? A presentation of my new ETF portfolio and what nobody saw coming this month. It's going to be a massive week, guys. Let's go. And welcome back to the Daily Market Review. What another huge day in the markets, especially looking underneath the hood at some of the hottest small cap stocks, which I will show you on the chart soon, including the list of 6 stocks I gave out on Friday that I said could be about to break out. I'll show you how they performed today, and stick with me because later on, I'll also be giving you a slide deck presentation, letting you know details on how you can follow my new $100,000 investing account that I'll be using my global all-weather ETF investing strategy on. And that's the same strategy that I've used to achieve a 65% return in one of my accounts in the last 3 years. So hang around for that, as I'm sure you'll enjoy it. But first, as usual, let's just take a bit of a bird's eye look at the markets. What's really moving out there today? We'll also look at some key data, hot names on the charts, then we'll get into the slide deck presentation towards the end of this video. S&P 500 almost closing at 6,700 for the first time as we continue to grind higher, thanks to mega cap tech. Once again, lifting today on the back of some big news that I'm about to show you. And so we're quickly approaching the end of September, the end of Q3, and we've now got all the indices doing really well. Quite a good catch up in small caps of late, but we've still got the NASDAQ ripping higher, up over 5% month to date, which I don't think nobody saw coming, considering September is historically the worst month of the year. Catching a lot of bears by surprise, with markets once again powered high today on the back of a blockbuster headline. Nvidia to invest up to $100 billion in OpenAI, which is a landmark partnership by one of the most used chatbots and the picks and shovels maker of this entire AI boom. Nvidia plans to invest up to $100 billion tied to building at least 10 gigawatts of Nvidia-powered AI data centers. Think millions of GPUs to train the next wave of model. The structure is two-part. OpenAI buys the chips and Nvidia takes a non-controlling equity stake as each gigawatt comes online, with the first gigawatt due to land in the second half of 2026 on Nvidia's new Vera Rubin platform. And so why this matters is because OpenAI needs it. They're securing massive compute, and it's great news for Nvidia as well, deepening its moat in AI infrastructure, and the arms race for AI capacity just accelerated. Expect regulators to have eyes on this deal. We'll also be looking for how it plays out with OpenAI's existing ties to Microsoft and others. But I do think it's a net win. More GPUs, more power, faster model progress. No doubt it's controversial though. Seen plenty of it online. People saying Nvidia just investing in its biggest customer. But like I said, I think it's a win-win for everybody and the entire AI industry. Big investment is needed for it to keep growing, as the industry is already lacking supply and capacity. It's growing at breakneck speed, and that helped to give the entire AI trade a lift today. Other big names like Oracle getting bid up here over 6%, and other smaller AI infrastructure plays like Iron having another great day, up 8.4%, along with other smaller AI-related names like Grail. One I've got on my long-term portfolio, focusing on using AI for early cancer detection, with a lot of positive developments. Bit of a moonshot with a market cap of 1.6 billion, but I think it has huge potential with a very asymmetric upside to downside. Also moving today is the companies that are going to power AI, small modular reactors. Oklo ticking up once again, and uranium miners still looking good on the charts. And one sector really picking up of late, batteries. One we've got in our stock picks portfolio, Microvast, having a very good day. And there's positive sentiment spilled over into physical AI, robotics. Another one in our picks portfolio, Symbiotic, moving up to highs here. And of course, my favorite I've got in my long-term portfolio, Tech Robotics, having a monster day, up over 24%. Now up more than double since I gave it to you guys a bit over a month ago. And now up more than threefold since I first told my options members when I last bought the dip at $1.74 a share on the 23rd of June. But as I've been saying the whole time, this isn't a swing trade for me. It's a long-term investment based on my bullishness towards the robotics sector, with Rich Tech being the best pure play on US robotics in my opinion. Recently just teasing the launch of a new robot at Nvidia's GTC conference in Washington, D.C., scheduled to kick off on the 27th of October. So all eyes will be on that, no doubt, creating a bit of enthusiasm going into that. Company suggested their October calendar is packed with demonstrations and activations. Events are aimed at showing customers and investors that the robots are real, functional, and ready for a wider rollout. But don't get me wrong, this is still very much in the speculative stage. They did switch last year from selling robots to leasing them. Revenue's still small relative to market expectations. We've currently got 400 robots in operation today, but scaling that to thousands of units will test their logistics, service capacity, and capital needs. But unlike purely speculative plays, Like I said, rich tech's deployment's alive, and their customers include some of the biggest names in retail, like Walmart. They recently did a China deal, closely partnered with Nvidia, and these all provide credible growth levers. But please be reminded, none of my content or services are financial advice. We all have different risk tolerance and investment objectives. We're very stretched here in the short term, got a few reversal signals, 68% above the 50-day VWAP. No doubt it's vulnerable to a pullback. And like I said, it's a very volatile stock. Going to see swings 30, 40, 50% easily, and potentially even more. So please don't be surprised when that happens, as it's very much expected and part of a healthy uptrend. And you've kind of got to think of volatility as the currency you pay for outperformance. And so the more tolerant you are of volatility, the bigger returns you can earn. And just revisiting the list of 6 stocks I gave you guys on the daily market review on Friday night, I said had the potential to break out this week. Happy to report 5 of them have done so quite well today. Ondas Holding up 8%. Soundhound AI up 6.5%. Another AI related stock, Nebius Group, broken out up 7.3%. CoreWeave as well, reacting to that Nvidia news. And this is the largest position in Nvidia's stock portfolio, CoreWeave, also performing well today. Tempest AI down 2.6% on a bearish engulfing candle. I do apologize for that one. But the last stock I gave out on Friday for a potential breakout this week, Red Cat Holdings, super hot ticker here. RCAT up 8.2% today on really good volume, potentially looking to take out multi-month highs this week as well. So like I said, the indices don't tell the true story. There's a lot happening underneath the surface in these hot stocks, thanks to the huge growth and capex in AI. Some forecast that power demand from AI data centers could quadruple in 10 years. I'd say there's a potential to go even higher than that. And ever since GPT was launched in late 2022, the cost of electricity in the States has shot right up more than a third. And this is still early days. So that's why all these new energy stocks, nuclear data centers, and even battery stocks have been ripping up hard of late. But it's not just small caps. Some of the biggest stocks out there continuing to move higher. Apple. Market seems to be pricing in a really big upgrade cycle for their new iPhone 17 with signs of early demand. And this is something the market's really been looking for with Apple, as it was really lacking in its recovery with the rest of the market after the April lows, doing quite a bit of catch up here. Still yet to hit all-time highs at $260 a share when Warren Buffett was actually offloading into that. Mid last year, Apple was about 50% of his portfolio, and so that helped build the consensus. Apple was overvalued, which was justified due to its slow growth rate. Now with the new iPhone 17 and the potential to integrate AI across its devices, even though it doesn't really have its own AI technology, it can easily license it, and it's still the #1 consumer brand in the world, so it'll always have that pricing power. Good technical signs today, upward momentum thrust, stock looks to be in a strong uptrend. And just like clockwork, Wall Street jumps on board the rally, continuing to chase it up with their price target. Goldman Sachs started the year with an S&P target of 5,800, which we've already beat by more than 10%. Now they have no option but to dramatically lift that with a year-end target now at 6,800, which is not even 2% from where we are now. And since the so-called smart money was largely sidelined Q2, Q3, on the back of the tariff tantrum, which they helped to induce, again, they've been mandated back into this rally. We saw that last week with equity fund inflows making yearly highs, and there could still be room to go. Just looking at Goldman Sachs equity sentiment indicator, that's still negative. And typically bull markets can run longer than what we naturally expect. In fact, momentum regimes have persisted for long stretches of time. When the S&P goes from 10% below its long-term 200-day moving average to above 3%, a bearish to bullish flip, the market can sometimes go on to make another 100, 200% before we finally get another correction. An object in motion tends to stay in motion. Isaac Newton said it 300 years ago. It's still true today. And a big driver of the market is a record amount of corporate buybacks. Large companies plowing their cash into buying back their own shares. We set a record last year coming in just over $1 trillion. We've already almost hit that now with still a full quarter left in the calendar year. But no doubt stocks aren't cheap. Traditional valuation metrics at all-time highs, but so is corporate earnings, growing at a healthy double-digit rate. They really need to keep up that pace to justify these valuations. And we'll get another look at that in 3 or 4 weeks when Q3 earnings kicks off. No doubt, I think we'll get plenty of beats across the board. Companies raising guidance, but they need to keep delivering that going into Q4, Q1 next year. Any signs that earnings growth may be slowing will cause the stock market to shake and rattle. But at this stage, things look to be up and to the right. And when things get so good and so obvious to everybody, that creates a torrent of buying, and we very well could be going into a bubble phase. S&P 500 may reach 10,000 plus before the secular bull market pops. That last year or two of the bubble, things can get very crazy. No doubt a lot of money can be made, but you do have to be careful as well. Don't want to get caught with your pants down. As Warren Buffett famously said about the stock market, when the tide goes out, you can see who's been swimming naked. But there is room for a lot more participation in this market. Currently only 6% of S&P 500 members sitting at 52-week highs. It's still very much been a story of the Mag 7, which we can see that in the Mags ETF. Just been motoring ahead and outperforming the equal-weighted S&P 500 index. So it's still these big tech stocks doing all the heavy lifting here, and they dominate the big indices. And I do potentially see a scenario where Mag 7 big tech can maybe pull back or consolidate for a quarter or two, and we continue to see a rotation into small caps, more sensitive to interest rates, which should be coming down further over the coming months. And since the Russell 2000 small cap index just broke out to a brand new all-time high on Thursday last week, that's a very good bullish signal, especially because they went sideways for 4 years. Looking forward, we can often get good 12-month returns coming out of that. And there's a look at the Russell 2000 monthly chart. You can see it's kind of a big cup and a handle formation, which is a very bullish pattern and definitely not as stretched as the NASDAQ Qs here. Not to mention, I think small caps are actually cheap. Trading on a forward earnings of 16 times in a raging bull market with short-term rates getting down to a 3 handle, this is one of the best setups we've seen in small caps for quite some time. And I'm starting to see that outperformance in my stock picks portfolio, heavily focused on small caps. Now up over 45% time-weighted returns since I started it in June last year, and I still think it's early days. Small cap PE actually went to 24 back in 2020, so still plenty of upside room to go. And like I've been showing, positioning in small caps is at historic lows as well. All the ingredients are there for me. Plus, the market is pricing in even more rate cuts than what the Fed thinks they're going to do. The market's been 100% correct the last couple of months, saying the Fed needs to cut, which they finally did, catching up to the reality of the market and the economy. Jay Powell doing his best to push back on all that the last few months, but he finally came around, along with the rest of his team, giving us a new dot plot, pointing lower next year, potentially getting down to the low 3s, just coming off the low 4s here. No doubt a great tailwind for small caps as well. Fed fund futures think we could be at 3% come June next year, with the Fed also catching up to the rest of the world, which has been in a big global easing cycle this year. In fact, we've now got 83% of all global central banks cutting rates. Looking back in history, this can happen going into recessions, but it also can provide a tailwind for bull markets. It's not shown on this chart, but we did have global easing back in the mid-late 90s. That helped to power a global bull market. It also, coming out of the bear market in the early 2000s, we had a lot of global easing, central banks cutting interest rates, giving us a pretty good bull market into '08. But a big difference between going into those past recessions was the leading economic indicators weren't in a recovery and expansion stage like they are now. We can see in the blue line, prior recessions, they were coming off hard going into it. And also looking back in history, typically corporate earnings fall in sync with the Fed funds rate as well. You can see that with the blue line, S&P earnings, and the Fed funds rate and the white line. However, we have a divergence here. Corporate earnings are trending up, growing on a healthy double-digit rate, and we've got the path of interest rates set to go lower. Looking back in history, the only time the Fed cut without falling earnings, the result was a dot-com bubble back in the mid-late 90s. Again, potentially showing the ingredients for an epic melt-up, which no doubt the dry powder is there to make it happen. With an ocean of new liquidity created in the last 5 years, I think is still playing out in markets to this day and potentially for years more to come. The Fed just simply went way overboard in 2020 and overcompensated for us all just sitting at home for a month or two. Jay Powell doesn't want to talk about that, but the reality is that's what's caused that huge wave of inflation back then, made the rich richer while most consumers struggle. And we can see that just looking at money market funds going up from 3 trillion to 7.5 trillion where they sit now. That's an increase of 4.5 trillion, which is 50% more than the prior 70 years it took us to get to 3 trillion. Liquidity in money market funds has more than doubled in just the last few years. Interest rates keep coming down. This money's going to yield less. All those wealthy boomers been enjoying their 5% rates for a few years now may start go shopping around in the stock market to keep their monthly income at the same level. And again, just looking here in the short term, technically ripping higher, but looking at sentiment and positioning, we're still not at far extremes. Looking at risk on versus risk off measures, the overall average still has plenty of room to grow, as things like the call to put volume ratio, sentiment surveys, and even the VIX hasn't reached rock bottom lows, and we're still showing more bears than bulls in the AAII sentiment survey. So no doubt there could be room to run, but like we often see in bull markets, we can still get plenty of rotation and volatility on the way up. And we saw that again today with crypto pulling back. Apparently over 400,000 traders got liquidated. Quite often younger guys using a lot of leverage, never really seen a proper bear market. In fact, crypto was created back in 2009 with Bitcoin being the first, and we've pretty much just had a secular bull market since then. Crypto's never really seen a big bear market, which will be interesting when we eventually do. But the pullback we got today spilled over to a few crypto related stocks. Recent hot name onto the market, Gemini, IPO a week ago, having a bit of a pullback today, but that could actually be setting up for a bit of a dip buy when it does find a bottom, as we're a little technically oversold relative to the volume-weighted average price ever since it came onto the market. But for that to happen, we're going to need to see Bitcoin stabilize. It's actually been consolidating for about 5 months now. What had been performing a lot better was Ethereum, but that just closed underneath its 50-day VWAP for the first time since we broke out in late June. I still think the dip will get bought. We just may come down and test the lower band, which again is what you want to see in healthy uptrends. Consolidation, form a base, and it can take off again. So I can see a level of support around 3850, potentially all the way up to 4000 here. We'll see whether the dip gets bought around here. What's still holding up really well though is gold, continuing its multi-year bull market, and we could be potentially reaching a tipping point in sentiment and positioning. Seen plenty of Wall Street come out and saying to increase allocations to gold. No doubt there's good fundamental reasons for it. We heard that with Jeffrey Gunlock saying go heavy on gold, and that investors allocating as much as a quarter of their portfolios to gold was not excessive. I wonder what he does think is excessive, 50%? And this same sentiment is echoed throughout Wall Street. Again, nothing changes people's minds like price action. And we're getting plenty of price target increases across the board, with many banks now targeting 4,000 plus, some even going 6,600. Morgan Stanley also recommending investors go 20% gold, and this meme here sums it up pretty well. Not many people want to buy assets when they're low. It's that classic sheep and herding effect, which often comes near market top. And so inflows into the largest gold ETF are on track to make a yearly record and take out the prior peak from 2020, and before that, the 2009-2010 period. And in the prior inflow peak in 2020, gold actually ended up consolidating for the next 3 years before breaking out. And then similar story in 09 going into 010. Did run up for about another year into 2011, but then after that, it was basically a lost decade for gold. It took 10 years to recover to new highs. And just going out to a quarterly candle chart here, I've got the fourth reversal signal firing off. The last time we got four, it did mark the peak of the 2011 run up. Got a few there back in 04, but that wasn't after the price had made new highs. It was still somewhat recovering. The prior big bull market in the 70s, it did keep going for about another 6 months or so before it finally found its peak, then a massive drawdown, going from $873 an ounce all the way down to $297. Commodities can have huge corrections after they have those melt ups. And so again, I'm not bearish on gold, but I wouldn't be piling into it here. As I've been saying, it's looking a little Johnny come lately to me. And it's like musical chairs. When the music stops, you don't want to be the last one running around. And no doubt what's been helping it is the US dollar having its worst year in decades. And the only other better performing year for gold was 1979 when it last peaked out. We're currently on track here in the blue line for having its second best year. And so I'll be really surprised if 2026 is another monster year for gold, since we've just had a couple in a row and getting some overbought conditions show up technically and with investor positioning and Wall Street sentiment getting very bullish on it here. That being said, nothing wrong with owning a little gold long term, but I wouldn't do as some of these banks are suggesting and put a quarter or more of my entire portfolio into it, as there are many other global assets performing well over the last year, which still have a lot of potential catch up. Emerging market stocks being one of the best, as they're still only a very small fraction of the global equity pie. China, the biggest emerging market at 3%. United States, still head and shoulders, 65%. And I'm not saying that can't get bigger. Who knows, it could go to 85%. No one knows for sure. But like we've seen in history, it doesn't go forever. Famous slide made by Warren Buffett in the early 1980s, and even explained back then, even though the economy was growing, companies were doing well. For 17 years, the Dow Jones Industrial Average went nowhere. And according to traditional valuation metrics, the next 10 years could potentially mean lower returns or even negative returns for US large cap stocks. And that's based on things like the Shiller PE ratio, which is a stock market valuation using 10 years of inflation adjusted earnings. My regular viewers know that I argue valuations are in a secular uptrend for many reasons, but no doubt we're still a little stretched here, even if you were to look at a trend line, which could suggest a modern day Shiller PE could be somewhere around 30. There's no telling how high it could go. We could easily take out the 2000 peaks, maybe even go to 50 or 60, but no doubt at some point it will revert back to a mean. I just don't think that we'll ever see lows, potentially in early 2009 ever again, and I'd be blown away if stock market valuations ever got back to the early 1980s or the early 1930s, as things have changed a lot since then. But the question is for us investors, how do we guard against that inevitability? How can we take away that uncertainty? How can we ensure that we're always invested in the strongest assets in the world, no matter where they are? or what they are. Even if American tech stocks keep outperforming for the next 10 years, or even if they're about to crash starting next month, anything can happen in market. And so how I plan to guard against that and protect and grow my wealth regardless of what happens is by using what I call the global all-weather ETF investing strategy. And so I've just made a quick slide deck presentation here for you guys as I'm about to open my ETF Portfolio Service this Thursday, where you can follow my real $100,000 account and find out the day before I make any trades in my account. Always done on the first trading day of every month. So first off, who is this for? Active investors that want rules-based growth, low maintenance, and clear execution. No matter where you are from the world, you're welcome to follow this service. And what it's not is day trading, it's leverage, it's making speculative bets, and nor is it vague trading ideas like pretty much every other FinTuber offers. As far as I can see, none of them put their money where their mouth is. They're happy to tell their members what to buy with no signs of them buying it themselves. And what they usually do is just flood you with content disguised as value, which if you're to follow along would take hours and hours of work every week. With me, I'm just focused on results because at the end of the day, that's all that matters. And so the objective of my ETF strategy is to outperform the major indices with lower drawdowns over time by using my unique momentum strategy. I'm seeking better risk-adjusted returns, more consistent returns. And over time, it's very likely to outperform any single asset. Because remember, every asset, doesn't matter what it is, stocks, crypto, bonds, gold, they can have massive drawdowns. I'm talking 50 to 70%, which always inevitably wipes out millions of investors because they base their expectations on their own experience instead of looking back in history, coupled with just guessing what to do, where instead the best results come by consistently following a simple, systematic, and proven strategy over time that removes the guesswork and emotions so we can profit from the most powerful force in global financial markets, and that is momentum. Hands down the number one returning factor, and that's been tested over 200 plus years. And so with my new ETF portfolio service that I'll be opening the doors this Thursday, I've created it so you can follow my real money trading account. I'm putting 100,000 US dollars of my own money towards following this strategy. And like all my services, I run it with full transparency and put my money where my mouth is. You'll know ahead of time exactly what ETFs I'll be selling and buying the day before I actually make the trades inside my real money brokerage account. And so how it works is each month I rank over 1,000 liquid ETFs using my proven momentum formula that looks at a number of things. And then from within the top 100 ranked ETFs, I'll buy new positions, always holding 10 ETFs equally weighted, rebalanced on the first trading day of every month. So typically I'll be selling between 2 to 4 ETFs and replacing them with new ones from within the top 100 ranked ETFs. It's a 100% systematic strategy, leaving no room for guesswork or emotions. My job is to focus on the process, not the short-term outcome, and just be consistent with execution. That's what delivers results. And the risk management is naturally built in by being globally diversified. Portfolio can hold a wide range of assets, equities, bonds, commodities, cryptos, alternative assets, strategy funds. Whatever's performing, my strategy will invest in and always hold a diverse basket, never getting too concentrated to any one sector or part of the market. And so by only owning the strongest assets and never owning downtrending or underperforming assets, that's just as much a form of defense as it is offense. Portfolio does have the ability to go partially or all in cash if nothing out there is uptrending. And that's based on the concept of dual momentum, which again has proven over time to deliver far better risk-adjusted returns. And so why I like to use momentum to invest in ETFs is not only is it the premier market anomaly, one of the most reliable factors in finance, beating buy and hold over decades. It's been proven on every asset class around the world going back hundreds of years. The thing we see in financial markets are persistent trends. You don't see that in random data. That's what makes markets different from random data. In the short term, very much be a little random, but over time, powerful trends develop. Big institutional money takes a long time to get in and get out, and us as small investors can jump in front of them by using a simple and systematic process. And this is the same momentum strategy I've used to make over 65% in the last 3 years in one of my long-term accounts, now more than tripling my fund manager's default fund. And so why I prefer to use ETFs versus stocks with momentum is not that momentum investing doesn't work with stocks. It does. It just comes with bigger drawdowns and periods of underperformance. And that's because ETFs just give you so much more diverse exposure. You could think of the US ETF market as a gateway to the world and global assets, not just America, giving us instant diversification, and entire sectors can often develop much more smoother trend with better volatility adjusted returns. And the thing I love the most about ETFs, There's no tail risks. Stock misses on earnings, it can gap down 20-30%. ETFs don't have earnings results. CEO of a company leaves. Stock gaps down 10-20%. Surprise news, loss of contracts, litigation, the list goes on. ETFs are far less risky than owning individual stocks. And so why did I create this service? Well, first off, I love the challenge and I love helping you guys and providing value to investors all around the world by sharing the exact same strategy that I've already been using for 3 years and I'm going to be using for many more years to come. I'm not going anywhere. I plan on running Click Capital for several more decades. It also complements my existing stocks and option services with an ETF service, now covering the 3 most popular asset types that I invest in myself. I don't have any more plans to launch another portfolio service. This very well could be the last one. And by doing this and creating a structured framework to grow wealth over time by making a commitment to helping others, I'm taking on a bigger responsibility that also helps to grow my own wealth. And so to put it simply, the more rich you guys get, the more rich I get as well. My interests are 100% aligned with yours, which again, you just won't find anybody else doing it quite like this. And so I know many of you guys are already subscribed to my stock pick service, which has been doing fantastic, significantly outperforming the market and the small cap benchmark since I started it in June last year. Did have a bit of a drawdown there with the tariff tantrum, but in my mind, that was a great stress test of my strategy. The Russell 2000 came off by 30%. For some traders and strategies, that's enough to wipe them out. And so that could very well happen again. My strategy will not only survive, but thrive coming out of it. And so it is a perfect complement to my upcoming ETF portfolio service. I kind of think of it as a barbell approach, which is a concept in finance that suggests you should own both conservative, stable assets with high growth, speculative assets, avoiding the middle. And so that's kind of how I think of combining my ETF portfolio with stock picks with some key differences. The ETF portfolio is really low maintenance, just rebalancing on the first trading day of each month. Stock picks is more active. I send a new pick out every Sunday and buy it on Monday, weekly investing. My ETF portfolio is based on momentum. Stock picks is more based on trend following. ETF portfolio gives exposure to global assets. My stock picks is more focused on small caps. The ETF portfolio is 100% systematic. My stock picks is more research driven. The ETF portfolio provides us stability and growth, while stock picks is more higher up the risk reward spectrum, giving us both growth and speculation. And so they're well matched together like a perfect marriage. And so what do you get if you join the ETF Portfolio Service this Thursday? First off, a comprehensive monthly report that I'll email to you before the first trading day of every month, letting you know exactly what ETFs I'll be selling and what ones I'll be replacing them with, along with market commentary and performance tracking of the portfolio. You'll also get access to a private members area showing all details of my current ETF portfolio, with records straight from my brokerage account, showing exactly how my account is performing, and along with access to the weekly updated top 100 rankings. And that's pretty much the engine behind my ETF strategy. And so you're about to always see what the top 100 ranked ETFs in the market are according to my unique momentum formula. Now onto the cost to join my ETF portfolio service. I'm going to be offering 3 different plans: a monthly plan for $99, a yearly plan for $990, that's equivalent to 10 months cost, and a lifetime plan for $1,990, which is equivalent to about 2 years cost. But for founding members, I'll be offering a huge 40% discount for launch week only, and that'll be the only and last time I offer this service with a huge 40% discount. And you can also take advantage of the 40% discount offer to combine the new ETF portfolio service with any or all of my other premium services in a package deal to get the biggest savings. I'm going to be offering a bunch of new packages on my site. And so this will be the best time to buy the dip on some Click Capital trading services, as they've been doing very well on the back of another very profitable month. And so just to give you an idea of the value that I'm offering and comparing the cost of my ETF portfolio service to something similar, typically to get access to a strategy like this offered by a hedge fund, you would need to invest a minimum of $500,000. And in most jurisdictions, you would also have to be an accredited investor. Well, let's say you found a capable financial advisor, unlike most, who just plow your portfolio into some managed funds, usually the ones that give them the biggest kickback fee. But let's say you found a financial advisor who could accept a lower minimum than a hedge fund to run an active momentum strategy using ETFs for you. They would likely charge you high fees plus around 1% of your portfolio each year, which over even just 5 or 10 years would likely add up to tens of thousands of dollars, and depending on your portfolio size, potentially more than $100,000 in fees, compared to the lifetime cost of my service being under $1,200, with the 40% discount applied. So I stand 100% behind my pricing and the value offered. And like I said, the launch week will be the only time I offer 40% off as a thank you for founding members. So make sure you come back to the channel this Thursday, the 25th of September. I'll give you the coupon code for the 40% discount, and you can join my new ETF Portfolio Service or grab a package deal if you want to get access to my stock picks, custom indicators, or my options chat room. And I'll be buying 10 ETFs come the 1st of October and kicking off this strategy, which has already been having a huge month. Now up over 9% for the month of September, well ahead of the major indices. And that's with a global diversified portfolio across multiple asset classes as well. And that's pretty much a wrap for the daily market review today, guys. Thanks very much for tuning in and watching this slide deck presentation. If you've got any further questions about this service, feel free to put them in the comments below this video or send me an email to support@clickcapital.io and come back tomorrow, because in the daily market review, I'll answer all those questions and a few more so you know exactly what this service includes when I open it this Thursday. That's all for now. I'll be back again this time tomorrow. Cheers.